Hello, thanks for watching this video from Bearing Point on digital payments. Bearing Point is an independent business and management consulting firm with around 4,500 consultants. If we include our partner consultancy firms, we are more than 11,000 consultants, giving us a global reach that allows us to follow our clients wherever needed. In this video, Karine Doudoux, Senior Business Development Manager of Bearing Point Luxembourg, and myself, partner at Bearing Point Luxembourg, will give our point of view on the changing payments landscape. The changes are complex. Some analysts even speak of a revolution. Hence, in the coming 50 minutes, we will be able to touch only the surface of the important challenges we are facing. Karine, maybe you can give a global overview of what's happening.
Yes, so for several years now, the payments area has been forced to transform itself. This amazing evolution results from the combination of several factors. First, this is due to new regulatory initiatives. PSD2 was designed to open up the banking industry to new players and promote the development and use of innovative online services while ensuring also consumer protection. It has provided the foundation for open banking, granting access to payment accounts. This framework has created also new opportunities with the emergence of a pan-European market open to new players, GAFAM and FinTech entering the playing field. This transformation is also driven by the adoption of new and innovative technologies, to name only two: artificial intelligence and blockchain. According to an IDC survey, financial services companies will spend $11 billion in 2020 in artificial intelligence, with substantial, of course, rewards expected in the midterm. Artificial intelligence can be used to fight fraud, and particularly for e-commerce transactions, enable and offer better and cheaper customer services, with the presence of chatbot programs, for instance, and allow digital interactions for consumers, like with mobile payments and online banking. Blockchain also brings interesting assets like embedded cryptography, resilience, distributed lead data, and tamper-proof processes. Of course, the use of these new technologies is made possible thanks to a deep modernization of payment infrastructure. Such initiatives are usually led by governments, central banks, and as seen previously, by regulators, in order to lead to efficient clearing and settlement systems, support real-time, and meet end users' expectations in terms of digital experience and payment security. To take the European example, the Eurosystem has launched a project to consolidate Target 2 and T2S to create a consolidated platform that will be launched in November 2022. This will feature a centralized tool that will allow participants to steer, manage, and monitor central bank liquidity across all target services. As a result of this evolution, what is key is the emergence of new customer behaviors, also fastened by COVID-19, with the spreading usage of contactless payments. So, based on this, financial institutions have to transform their payment business model. Herwig, maybe we can now go further into detail with some major trends.
Yes, of course. The first one is changing consumer habits. We all notice that our payment habits have changed compared to those of our parents. The use of classic methods like cash, check, and credit cards are progressively replaced by mobile payments and even digital currencies. The sanitary crisis has accelerated the use of online payments, with a rise of e-commerce by 20% during the quarantine and the shifts to contactless payments. Regarding the future of digital means of payments, there is of course the very likely disappearance of checks, since it's not even used anymore in many countries. The usage of credit cards is under pressure by mobile payments and new hybrid solutions such as Apple Pay. Instant payments is a further threat for credit card usage. In the developed countries, there will probably be a place for different forms of payment, but on the contrary to emerging countries, the transition directly from cash to mobile payments without ever owning a plastic card will not be the case. Regarding cash, The trend is now to use it for small payments, and several countries have even removed large notes from, for example, $100. However, cash still has interesting properties: anonymous, accepted almost everywhere, secure, no cyber attacks, and allowing people to feel better when they spend. So Karine, maybe now we should talk a little bit more on the effects of digitization and data.
Yes, so thanks, Herwig. Indeed, these new habits push towards digitalization transformation and create value disruption for banks. Having based their revenue model on transaction fees that tend to decrease to be free in the future, payment services providers must evolve towards data-driven services model. Data is the new gold and bring new opportunity for banks and corporates. Therefore, using data will be a decisive differentiating factor for banks and other players. So how can they benefit from it? A data-driven value creation strategy is made possible using emerging technologies, and as you can see in the scheme behind, requires a personalized, scalable, and efficient information system that collects and stores large amounts of data, which means an ability to unlock data sources and allow implementation of analytical capabilities that are key for data exploitation. Data exploration offers internal opportunities and values for companies, like the ability to improve product development, target market and sales efforts, drive operational efficiency, and enhance risk and fraud management. These value-added services will be a benefit also for customers, for example, the provision of specific advice in real time. And of course, this is the opportunity to generate new revenue stream for payment services providers. But these new technologies also need a reinforcement of cybersecurity.
Indeed. Thank you, Karine. The risk of fraud needs to be handled carefully. As you can see here, we have some statistics from American Express Digital Payments Survey led in 2019. 70% of online sales end up as fraudulent transactions. 69% of the merchants in the US are spending significant time and expense to dealing with payment fraud. Luckily, existing regulations already provide strong guidelines and requirements to ensure security and fraud. PSD2 provides regulatory technological standards on strong customer authentication and secured communication, which highly contribute to enhancing transaction protection, promoting innovation, and improving the security of payment services across the European Union. New methods also contribute to solve current fraud issues. With the development of biometric identification, consumers can now use fingerprint or facial recognition to unlock a mobile phone. We also see government initiatives that aim at reinforcing operation securities, like the Indian government that has collected biometric data, fingerprints, retina scans, and facial recognition from more than 1.2 billion of people. We just must be careful that these security requirements keep enabling an easy and fluid usage of new payment needs. And of course, Karine, there are also the geopolitical challenges.
Yes, of course. And the fourth and last trend is about international competition. Beyond consumers' habits and the new power of data, the transformation of payments landscape leads to a hard competition, having profound consequences on economic and generating geopolitical strives. Christine Lagarde admitted in early September in an ECB speech that Europe has fallen behind in this competition, allowing foreign providers to take the lead. If we have a look towards the Asian area, China is developing a world-leading digital payment infrastructure, as well as India. Their online payment represents almost 3/4 of gross domestic products, and almost 50% of in-store purchases in China are made via digital wallets. The country is also working on a digital currency back to its central bank that can be used as a power tool, since companies doing business in China are forced to adopt the digital one. This could lead to the erosion of the dollar's primacy in the global financial market and shift the epicenter of global economic power. In parallel, technology firms like GAFAM are also affecting European payments. If we take the example of Facebook, it leverages on its network to develop and expand Libra footprints. But many risks are raised by the creation and usage of these private cryptocurrencies. Market abuse power, question of the ownership of critical data, volatility and potential convertibility issues, and monetary sovereignty that could also be weakened. To face this evolution, first, the Eurosystem has already reacted by the launch of technological initiatives like Target 2 consolidation. And we can also mention EPI, the European Payments Initiative, with the ambition to create a unified pan-European payment solution based on instant payment and SEPA. Secondly, Christine Lagarde has announced a few days ago that the Eurozone central bankers are close to deciding on whether to press ahead with the development of a central bank digital currency, the CBDC. When we have a look to other international initiatives, we see that the first stablecoins was created in 2014 to minimize price volatility, and many governments have already started to issue their own cryptocurrency. For instance, the USA created the USD coin in 2018. The Central Bank of Sweden also announced an e-krona and started testing the proof of concept in 2020. China has the digital yuan and India the digital rupee. Therefore, it's really time for Europe to have its digital euro. So in summary, we can say that there are quite some challenges.
Yes, as explained previously, the payments landscape is changing quickly. Numerous and concurrent initiatives are occurring in parallel. At the same time, costly infrastructure and regulatory changes are demanded. Furthermore, new, most often fintech players are entering the market. With all these elements moving at the same time, it's difficult for corporates and even more for payment service providers to have a clear view on how to position themselves for the future. The essential, basic and fundamental trend is clear. We are moving to an environment where payment transaction will be instantly, contactless and for free. The general long-term consequence for payment service providers is clear as well. An earning model based on transaction fees is not sustainable. Future profitability will come from the provision of data-driven, value-added services. But just knowing the general trends is not sufficiently for building a long-term value business model. In particular, for small and medium-sized organizations, it is too costly to participate in all ongoing initiatives. Choices need to be made, and making the good choice is especially important if we take into account that in-depth transformation with an unclear return on investment are required. We already know some additional important building blocks underpinning the business model of the future: embracing open banking, developing cross-border instant payment services, adapting to new and changing infrastructures and international standards, and finally, taking into account the growing trend of tokenization. But this is not enough, because every payment service provider situation is unique. Hence, we propose our clients a tailored approach. After a SWOT analysis of the current situation, we define potential future scenarios taking into account competitive advantages, profits, costs, and risk. The final outcome is the definition of a sustainable business model for payment services.
So great. We thank you for watching this video, and please do not hesitate to contact Herwig or myself if you want to discuss further this interesting topic. Thank you.
Thank you.